Good morning, and on behalf of all my colleagues here at Colliers International, I'd like to extend Richard's welcome to you here today. We're at a very interesting juncture in terms of the dynamics and likely forward momentum for the property markets in Central and Eastern Europe. Some of you will be familiar with the GDP story that we've had in Central and Eastern Europe for the last 15, 20 years, one which has seen positive GDP growth, the convergence factor that has been on everyone's lips for a very long time in the region, and the cycles that we've seen have been driven largely by exports. But what's different about this cycle, I believe, and in cycles going forward, is that the consumer in Central and Eastern Europe is going to become more important and perhaps eventually dominant in terms of what's driving certainly the real estate markets. In the consumer, the link between the consumer and the retail sector is obviously is obvious to everyone in this room, but the participation of the general population in these economies. Remember that we're talking about a population here of nearly 100 million if you take Central and Eastern Europe as a whole. The participation of the population is rising in economic activity and will continue to do so. What I've got on this first slide is a leading indicator in economic sentiment amongst consumers in some of the key Central and Eastern European countries. So we've got Romania, Hungary, Poland and the Czech Republic. What you can see is cyclical activity. So here's the trough, the great financial crisis trough. But even from that trough, activity and sentiment didn't pick up massively compared to where it was prior to the crisis. What we have at the present time is a stronger recovery in sentiment, and this recovery has been going on for 3 or 4 years, and particularly in Poland and the Czech Republic, as you can see from the mid blue line and the dark blue line are approaching levels that we saw only in 2006 and 2007. So the consumer in these economies is becoming more confident, and if they become more confident, then they will start spending more money, and that is precisely what is going on in these economies. Economic growth in Central and Eastern Europe is between 2 to 4%, with the exception of Romania, which is actually growing a lot faster, around 4 to 5% in 2016, having grown even faster in 2015. So we've got strong momentum in the consumer space in these economies. Now, what does this mean for the real estate investment world? What I've done here is taken that dark blue line as a composite of those previous four, blending together those previous four lines, the 4 lines on the previous slide. What I've done is also what we call lagged it, so pushed it forward 18 months in time. And you can see there that there's some predictive ability of the dark blue line to predict the light blue line. The light blue line is the investment volumes that we've seen in the core Central and Eastern European countries, the CEE 6, so that's Poland, Hungary, Czech, Slovakia, Romania and Bulgaria. This line seems to be predicting continued strong volumes. We had 4.5 billion into the region in the first half of 2016. So that 4.5 billion we would expect to see over the next year or two if this leading indicator is correct. The region is also becoming more popular in the EMEA context. So with Brexit and other events in Western Europe, with instability elsewhere in the EMEA region, even in places like South Africa, what we're seeing is an increased share of mind. Central and Eastern Europe becoming more interesting to the investor base. So here I've measured the percentage of the total investment volumes that are going into EMEA as a whole, how much of that has been captured by Central and Eastern Europe. And we're, in the first half of 2016, almost at a 5-year high. And we've got a long way to go. On this chart, on the left-hand side, I've calculated the investment volumes as a percent of GDP. So how much of that money that's going into the region, into the Central and Eastern European region, how much is that compared to the total size of the economies? So, for example, at the moment, In somewhere like Romania, it's only 0.3% of GDP. It's very small. Even in Poland, which has obviously seen a lot of money over the past few years in terms of volume, still only 0.5% of GDP. This is not a very, very high, large amount. Compared with, obviously, outliers such as the UK and Sweden are up there at over 3% of GDP. But on this scale, as the GDP per capita rises, as the people in the countries become more rich, as the economies grow, then one should expect, looking at this line of best fit, that the percent of GDP rises, the investment volumes rise. And obviously, as the investment volumes rise, the liquidity of the market is rising. So there's transactions, someone's buying, someone's selling, all of the time. Something's being developed, someone's selling. So the liquidity goes up. The liquidity goes up, and the market becomes obviously a lot more active, and people become more confident just transacting there, being there. And so the countries climb the slope over time. It's interesting to see that Spain and Italy, struggling, representing the struggling southern European economies, are down there with higher GDP per capita, but not seeing substantial investment as a percent of GDP. There's a confidence issue. So you have to be confident in the future, particularly in this asset class, being relatively illiquid compared with other asset classes. So we should climb over time. We should hopefully reach 1 to 1.5% of GDP as the GDP per capita continues to rise and these economies continue to converge with the Western European peer group. What's happening right now? In the first half of the year, we had a very good first half. So pre-June, we had a very good first half. So comparing, this is the first half's investment volumes in the countries compared with the average of the previous 6 years. Quite a significant jump in the first half. 52% jump in Hungary, 45% jump in Poland, 36% jump in the Czech Republic. This is compared with 22% jump in EMEA overall. By sector, retail sector, big leap, very significant jump in the retail, industrial and office following, but not quite as strongly. So retail really driving this, and to a certain extent industrial as well. What's happened since the 23rd of June? The infamous Brexit. Have we seen a slowdown? This is the number of deals that recorded in the Real Capital Analytics database since the 23rd of June, or second half. 72 in Poland, compared with 149 for the whole of the first half. So just slightly, and this obviously this is second half to date. So it's just over a quarter of time. I took these data on the 20th of October. So just over a quarter. So you would expect, if it was running at the same rate, 75 deals. So it's just about in line in terms of number of deals in Poland. The others are actually ahead. So in terms of numbers of deals, it doesn't look as if there's been a Brexit shock, let's say, in terms of activity. Deal size, however, weaker, particularly in the biggest market, Poland. Fortunately, we have 400 to 500 pending deals, 400 to 500 million of pending deals. So that number would move up quite substantially, probably if I took these data even now compared with a week ago. Poland's the exception there. The others still holding up. Hungary's actually ahead. Hungary's had as much volume in the third quarter of this year as it had in the whole of the first half of this year. So Hungary's continuing to see strong momentum. The others, as written up here, are in line with the momentum that stronger momentum that we saw in the first half. So the Brexit effect in practical terms, yes, maybe in Poland, but not substantially yet elsewhere in the region. But obviously we have to wait and see in terms of the future. As I've hinted, the strongest dynamics are in the retail sphere, and we've got strong underpinning here. Some of you know one has very high occupancy levels in the higher quality retail assets in the region. What's this underpinned by? Rents. We look at the rents in 2011, the dark blue bars on the left-hand side chart, and then we compare them to the lighter blue bars, which are the rent levels in the first half of 2016 in the prime assets in the capital cities. You can see substantial firming of rents, particularly in Warsaw and Prague. Elsewhere as well, in nowhere are the rents lower. So strong underpinning there. And then the yields have also, as activity has picked up, as transaction volumes have picked up, the yields have fallen, and the yields are presented there on the right-hand side. So Warsaw moving in 50 basis points, the likes of Bratislava moving in by more, 175 basis points. So a very firm sentiment in the retail sector, certainly demonstrated by these statistics. So quite a positive outlook in the longer term, certainly. How might this be derailed? How might this growth trend be derailed? The shadow of Brexit. We've got the concern over sentiment and currency effects connected with Brexit. Currencies destabilising due to the shock of the event and the consequences, let's say, for the whole of the European Union that we might see. There's a lot of speculation going on the continent, and I can vouch for that living in Prague myself. A lot of debate about what's going to happen to the European Union. How is it going to be reconfigured? What's going to happen over the next even 12 months in terms of the major political events that we're going to see? The rise of Russia. This is all dependent on the oil price. If the oil price is $20 a barrel, forget Russia. If the oil price is $50 a barrel or higher, Putin's in the game. And if the EU has political or economic problems, you can bet your bottom dollar that Russia will be in there somewhere, meddling, playing games as it always has done. So there's maybe a power vacuum, maybe an economical, political power vacuum that could see more influence of Russia, and that's a risk factor, particularly with a less liquid asset like real estate. One has to consider a longer timescale, so one has to be aware of what might be happening underneath the surface. The EU banking crisis, is this a risk? There's a lot of speculation about Deutsche Bank at the moment. And I can speak from my experience. I know the levels of leverage that exist within that bank at the moment are quite extraordinary. And it remains to be seen whether this is actually resolved in a way that does not disrupt financial markets substantially. The Italian banking sector has a huge amount of bad debt in it, and this also has to be dealt with. And we are not seeing yet a proper way forward for that country. What might happen if QE disappears in the EU, in the Eurozone? The efficacy, the efficiency or the usefulness of QE in the Eurozone is already being debated, already being questioned only 12 or so months after it was properly introduced and negative interest rates were deployed in the Eurozone. We've got distortions in the credit markets in Europe, which are, in my view, nonsensical. We have nearly a quarter of all corporate debt that's been bought by the ECB as part of the quantitative easing program is trading at negative yields. There's debt being issued by corporates that is just being bought by the ECB immediately. It's not even touching the market at negative yields. This is, as someone who's looked at listed companies for a long time, this is nonsensical. You do not issue debt, and you do not allow companies to have debt with negative yields over a long period of time, because if you allow every company to do that, the return on your investments will fall to zero over time. We see this in Japan. We've seen it for 20 years in Japan. So the distortions in these markets are becoming a bit crazy. Last week, one of the companies that the ECB bought debt of, K+S, the German potash producer, was downgraded to junk status. The ECB had bought this debt beforehand as part of its QE program, and now owns a company that's sub-investment grade. They've got real problems here. The real estate cycle is long in the tooth already. This is evident. We've had the consequence of several years of easy funding, and yields are therefore compressed because funding has been quite easy and there's been activity. So there's a danger that, as with every year, you need autumn and winter to follow spring and summer. If you don't have that, then the following winter might become rather intense. But just to cover Brexit quickly, if I may. The origin of investors into Central and Eastern Europe in 2015, we put together the figures. You can see that 13% of the money in 2015 that went into those core CEE countries came from the UK only. So yes, it's there, but it's not dominant. The US, Germany, much more important. Places like South Africa, you can see they're 8% and rising. These are 2015 figures. First half 2016 will show even more emphasis from sources such as South Africa. So we've got a diversified, increasingly diversified source of investment going on. But the Brexit shadow, this is a theme that is gripping financial markets at this point. And from my point of view, there is quite a lot that's not yet priced in to the European space. So just to illustrate, this line here is taking the British pound versus US dollar and looking at how volatile it is on a daily basis, taking that, as we do in the financial markets, taking it every figure for a month and plotting that. So the annualized volatility in the weeks after Brexit rose to 34%, which is a huge figure. You can see that just goes completely off this scale. The scale's up to 20. Just goes completely off the scale straight after Brexit and stays there for a while, and is now still at elevated levels. So we've seen a rise in volatility due to Brexit, no surprise, and it's staying there. People are very uncertain about the future, and obviously almost everyone in this room will have views on that, and that illustrates this point. So what's happening in the Eurozone? Well, not much. And this is the danger at this point, with potential for EU banking, an EU banking crisis with a potential for other issues to rise, such as politics and whether Merkel survives the German elections next year, whether the Italian Prime Minister survives the constitutional vote in December. There's a lot of factors in the markets that can destabilise things, and therefore will we see the volatility of the euro pick up? Because, as I say, this is the biggest currency cross in the world. This is the most liquid currency trade in the world, euro, US dollar. And yet the market is not really worried at this point about anything. I think that's dangerous. Looking at the region, the most liquid currency cross in the region is euro-zloty. So the euro versus the zloty, how's that moving around? Apart from some spikes, some small spikes in the past year or so connected with the change of government in Poland that we saw last autumn, we haven't seen much volatility there. So again, the degree of complacency, let's call it that, is very high, and therefore the probability, in my view, of this blue line rising is greater than it's falling. So again, in thinking about investment over the next 12 months, one has to bear in mind what is going on in Europe, connected with the Brexit shadow, and therefore the potential for greater instability. And I can tell you in credit markets, as I was hinting when talking about what the ECB is doing, there is absolutely nothing priced into credit markets in Europe because of the ECB's actions. The ECB is buying lots of debt, suppressing the yield. The bulls in these markets will say, this time it's different. Well, my experience, having gone through several cycles in emerging markets, is it's never different in the new cycle. So very likely that we will see more instability over the next 12 months rather than less. Just to close up, we do have a cushion. If we see interest rates rise, if we see the end of QE and interest rates rise, we do see some domestic pressures maybe in some of the Central and Eastern European countries as the economies are growing healthily. We have wage pressures in places like the Czech Republic. We could see interest rate rises over the next 12 to 24 months in several of the countries. Will we see yields in the Central and Eastern European region rise? Perhaps. But we've got a big cushion. This chart is illustrating that cushion is between 4 to 6% in most countries across the region. This is the gap between the property yields, the weighted property yields, prime yields in the countries, and the funding rates. Now, obviously, this is not capturing all-in costs. There's obviously a lot of costs which that are higher than the simple bank rates or the bond yields, but it's an illustration. We've got quite a big cushion. So yes, that real gap can close if we have a rise in interest rates, and therefore the premium, the yield premium that the investor is expecting may fall. That may make a difference. But I don't expect big backing up of yields unless there's substantial crisis conditions occurring over the next couple of years. And then very briefly, we've ranked here all of the European countries, so from the perceived safest to the most dangerous, so Germany at one end and Ukraine at the other, and looked at that's ranked by overall blended political, economic and demographic scoring. And we've looked at the weighted yield in the real estate markets, taking the maximum of the range of yields. And a couple of our markets look expensive, but this is not substantial. We're talking here Czech Republic maybe being 50, 75 basis points expensive compared to some theoretical line of best fit that we've drawn on that chart. So this is not an exact science, but it's giving you an idea that some countries in the region are slightly expensive, but not really priced out of this world at this point. So there's no real threat of a substantial yield backup. So to conclude, growth drivers, strong internal demand, especially from the consumer, and as I said, this cycle and the next cycle will become, the consumer becomes more and more important. We've got good external underpinning from Germany at this point, less so from the rest of Europe. And also the German leading indicators, even 2 days ago, the IFO survey was quite strong. Good underpinning there. And also, something I haven't illustrated, a potential bottoming of fund outflows from emerging market assets across asset classes. We've had outflows for 5 years. And those outflows stopped in the second quarter of this year. They've stopped, but they haven't started, we haven't had a big reversal yet. But the outflows have stopped, so that's an interesting thing that I'll be watching over the next 6-12 months, see whether that bottoming out continues. If it does, that's positive. Investment intensity rising as convergence occurs, as the economies strengthen, as the consumers within the economy spend more, then the investment intensity in real estate should rise, particularly in the retail arena. And also, these countries are run quite conservatively. And I can say this as a resident of the Czech Republic, a taxpayer in the Czech Republic. I'm very happy under the Czech financial regime compared with, say, living here. In terms of fiscal balances, it's certainly the case. Therefore, we have a flight to safety. We've been also incentivised by higher yields. There are higher yields present in Central and Eastern Europe, so therefore you're being paid more to be there. That's a good balance in my view. So what are the risks? I've been through them already, so I won't mention them again, but obviously the shadow of Brexit is there and is manifest in maybe more than one way or more than one asset market.